I'm currently the head of the international department, and just to give you a little bit of a rundown on what the international department does, for context, we monitor and analyse developments in international financial markets. We look at what international central banks are doing, and that's all about putting together advice for our Monetary Policy Board. We also manage Australia's foreign exchange reserves, so we're in a position to use those reserves to support our policy mandate, should that be necessary. We also manage the RBA's international engagement with a number of international groups. So the G20 would be one, the IMF, other central banks in the region. So that's a pretty broad remit, and over the last couple of years we've been doing an increasing amount of work on climate change. So some of that has been related to our international engagement work. It's almost impossible to go to any international meeting of any kind these days without climate change coming up. But we also coordinate the internal work at the bank, which contributes to the domestic policy agenda, and in particular it touches on the work of the Council of Financial Regulators and what they're doing with climate change, which I will get onto towards the end of the presentation. Just as a little extra piece of introduction, it's actually a thank you. So another feature of me that's not related to my work life but my home life is that I have a daughter who is currently halfway through her HSC in New South Wales. So I thought it was a great opportunity to say thank you to all the teachers out there. I don't think any of you actually taught my daughter, because she diligently avoided economics the whole way through her high school career. But I have to say it's been a very tough year to be doing your HSC, and the support of teachers has been extremely valuable. And I thought it was just an opportunity to put out a general shout out thanks to you guys. So on that note, I will turn back to the far less emotive topic of climate change and central banking. So just as an outline, I was going to start with a couple of definitions, which I think really help frame the discussion of how how climate change has touch points into central banking. The specific points I'm going to cover are how climate change affects the macroeconomy, and therefore, almost by definition, monetary policy, which is quite clearly in the central bank's mandate. Climate change is a source of risk for financial stability as well, so that's also quite clearly in the central bank's mandate. The third point I have here, and this actually came up, it comes up periodically in international discussions mostly, and I heard it most recently at an international meeting last week, which basically says that climate change is an existential threat, and therefore all instruments of policy should do what they can to, within their mandates, to assist dealing with that problem. So I think a really nice way to think about that is to think about the recent experience we've had with the pandemic. So the primary policy response there was really around health policy and fiscal policy. But given the nature of the issue that we were facing, there was a very clear mandate for monetary policy to provide support to those policies, even if we weren't kind of the front line. So throughout the discussion, I'll try and highlight where central banks have policy instruments that can be used, and importantly, there are definitely examples where monetary policy and other central banking tools can't be used. So I've gone one too far. Definitions. So basically, the way I think about this, or start thinking about this, is to divide the climate risk into two types. One is physical risk and one is transition risk. So physical risk you can think about as having an acute element and a chronic element. So acute is to say there's a climate event. It's the direct effect of a cyclone, of a drought, of a flood. The chronic risk captures things like the trend increase in temperatures and the direct effects that has on the way the economy works. The second type of risk that we think about is called transition risk. And that's in some sense an indirect risk. So you have climate change going on, and there are things that change about the way the economy works that then have second round impacts, if you like. So the obvious first one there is policy changes. So there's policies put in place to mitigate climate risk, policies put in place to adapt to climate risk, which changes the incentives and the signals that individual actors in the economy respond to. An interesting dimension of this is that you naturally turn to local policies, but actually in this space, what happens in the international sphere can have quite a big effect on the domestic economy as well. And I'll go through an example of that in a little bit. The second one here is technological change. So we know that technological change is just an ongoing process in the background, but I think it sort of achieves a special status in the climate policy and how do we deal with climate change debate. So that's quite clearly true for Australia, where a lot of emphasis has been put on the ability of technological change to help mitigate and adapt to climate risk. But whatever technologies are available are going to affect the risks and the opportunities that are out there. So, they in turn can have an effect on the economy. And the last one I have here is behavioural change. So we think about consumption decisions. Again, I'll go to my daughter. She's made a conscious decision to become a vegetarian because she wants to reduce her carbon footprint. So if enough people are making those sorts of decisions based on what they want to do in response to climate change, that will also have effects on the way the economy works. So let's just talk through how some of these climate change effects play out in terms of the economy. So the first one I wanted to talk through just quickly was acute physical risks from climate change events. So at heart, these are traditional supply shocks. Australia has a long history of climate events, so we really know, what they are, how they work, and what to do with them. And I think the feature here is that you tend to get price movements that are pretty isolated to specific products. So we think about them as a big relative and temporary price movement rather than a generalized increase in inflation. So you can see on this graph, because I think Timmy said no economist can get through a presentation without a graph. I've got a few. So this is just one of our classic examples of climate events creating large relative price shifts that we think about as supply shocks. So you can see in the left-hand panel there, I've got fruit prices. You can see those two very large spikes. They are in fact banana prices in response to two cyclone events. And you can see when you look across on the right-hand side, that sort of makes the point that the cyclones took out the banana crop. There were no bananas. The cartons per week coming out of North Queensland went down, the prices go up. So that had quite a significant impact on the CPI numbers that we saw at the time. But because we understood where they had come from and that had an expectation they'd be temporary, the right response for monetary policy in that instance was basically to look through it. And I did sign in just a little bit early, and I think this is actually kind of pitches through to the question about stagflation. So the exception for monetary policy is when a temporary relative price shock gets baked into inflation expectations. So that second round effect is where you can have a more general increase in prices. And that starts to play into the question, well, maybe the central bank should be responding because they have a mandate to anchor inflation, in our case, between 2 and 3% over time. And this anchoring and the framework of monetary policy that we have, I think, has a heritage that goes back to that episode in the 1970s where inflation expectations weren't well anchored. Obviously, banana prices are quite specific, so it's a little bit easier to sort of make the point they're a temporary supply shock than some other shocks. And in some ways, that's sort of where we find ourselves when we get to the question of how these more chronic physical risks and transition risks affect the macroeconomy. So you would expect them to have much longer lived effects on the economy generally. So the question could be asked, well, does it sort of translate as a series of negative supply shocks? And at what point do you say, well, it's not temporary anymore? That's one way of thinking about it. Another way of thinking about it is to think about how those longer lived effects play out through things like productivity growth and changes in the industrial structure of the economy. So when we get to the topic of structural change, there's absolutely a role for policy, but it's not really monetary policy that's going to be the policy that helps manage that transition. But obviously understanding the structure of the economy and how smoothly that process of structural change is occurring is really important context for the monetary policy decisions that need to be made. So what I'm going to do now is turn to an example of thinking about, or how you might think about the potential implications of transition risk. And to do that, I'm going to use a bulletin article that's recently come out from the bank. So I've got a link in the slide here and it's available on the website. So you can get all the details from there if I don't go into enough detail for you. But basically the article asks, what are the implications of net zero commitments in China, Japan and South Korea for Australia? So that's an example of policy decisions made internationally and how that might affect us. So you can see on the left-hand side of this graph, it's a bit of a stylized path for carbon dioxide emissions that these countries have sort of promised to achieve. You can see for South Korea and Japan, their ambition is to achieve net zero by 2050. For China, it's 2060. And they've also made concrete statements about what they're hoping to achieve by 2030. Having said that, there is a lot of detail missing on exactly what technologies they're going to use, how they're going to get there, what policies they're going to put in place. So the question is, what is the type of analysis that's going to help us get under the skin of this question? The answer to that is scenario analysis, and that's a tool that's used really extensively in the climate space. And effectively what you're doing is you're saying, okay, well, we've got an emissions path, we're going to get from A to B. We're going to set up a set of assumptions that are internally consistent and all the variables that go with that, that achieve this outcome. It's one possible future to achieve that outcome. So it's not a forecast. It's not necessarily even the most likely outcome, but it's an internally consistent set of variables and a description of a possible future. And what you're trying to do is, in this case, if you look at the right-hand side, we've got a number of different scenarios. And so the net zero scenario is one. One of the baseline scenario, if you like, is that current policies continue. So by comparing the outcomes under two different scenarios, as long as you understand what the different assumptions are underneath those two scenarios, it gives you a way of saying how important is this assumption effectively. So I'm going to talk about scenarios a little bit. So I'm going to take a brief diversion just to explain where these scenarios came from. So they came from a set of scenarios that have been set up by a group called the Network on the Greening of the Financial System, the NGFS. I will use that acronym again, it's too long to say the full name. And this is a group of central bankers and regulators that have been working together since, I think, 2017 was when it was first founded, to try and understand how climate change plays into the sorts of responsibilities that central banks and regulators have. And one of the work streams of that international group is a work stream that spent a lot of time putting together these scenarios, thinking through what are the most useful scenarios, what are the features, what's an internally consistent set of assumptions that we can put together that allow us to say something about this global problem, but also take that kind of global set of narratives, if you like, and translate them down to the national level. So all of these are taken from there. All the scenario work I talk about from now on will be one of those scenarios, because they really have become somewhat of an industry standard. So as you can see from the right-hand side, as you might expect under a current policies assumption, you get an increase in coal exports from Australia. But when these countries are making commitments to net zero, they are actually making pretty significant commitments to reduce or eliminate their coal-fired power stations. So that has a first-order effect on Australia's coal exports. So you can see that effect on coal exports. You can also use information about how important those coal exports are to GDP to do a calculation of what that aggregate effect is. And the answer is actually, it's quite small. So because of the timeframes we're talking about here, that effect is about 0.1 percentage point of GDP per year. But if we look comparing between the current policies and the net zero scenarios. So a couple of comments I just want to make before moving on. Monetary policy is essentially about macroeconomics. And when we say this is a really small effect, I think it's really important to then take a step back and say, this is some pretty serious structural change, and it's going to be particularly concentrated in some industries and some regions. So the effects can be very, very large, depending on how you're looking at it. As macroeconomists, it's very easy for us to go, oh, it's not that important, but it can be. So I think it is important to emphasize there's a huge role for policy to manage that transition. And there's a whole range of policies that we could use to do that. I think structural change is not a particularly new thing in Australia. So we know about active labour market policies. We've seen them work well. We've seen them work poorly. We've hopefully learned some lessons from those experiences. We also know that infrastructure investment by state governments in particular can be really helpful for in enabling new industries to take over. But monetary policy is not one of those, not one of the policies that's going to be very helpful here. The other point I just wanted to make before moving on is we're talking about change, and some of that change is going to effectively represent downside risks for particular industries, but it also creates opportunities, and it's important to kind of keep in mind that there are positives potentially if we set policy the right way. So I've put in there the example of green hydrogen because that is something that gets talked about quite a lot, but that has the it's a proven technology. It needs to be scaled up. It can be located in some of the same places where current coal mining takes place. So, maybe it's going to help with that transition. It can boost investment. It can increase productivity growth. So, change means risks and opportunities, I guess, is just a point I'd like to highlight there. So I'll turn to climate change and financial stability. So basically the two ways that that plays out is because climate change affects asset values, and it can also have a fairly significant effect on the ability of borrowers to repay loans. The value of assets can be affected by acute physical risks like an event, like a cyclone, flood. It can also be as a result of the structural changes we were just talking about, which means that an asset, for example, or people don't have the capacity to earn the same income that they used to. And so this is sort of where we end up in the world of stranded assets. It can also, I think something that gets a little bit missed is that climate change can really have an effect on people's ability to earn income where their income depends on natural assets. So the easy example here is agricultural land. So if climate change makes that unfarmable for because it's too hot or you don't have enough water, that obviously affects the asset value of the farmer as well as the income. But it's also things like ocean warming and ocean acidification basically makes it impossible for things like the barrier reef to continue to be the natural wonder that it once was. And so, there's a lot of people that rely on tourism to the barrier reef that will also lose their income. So there's all sorts of different ways that this can play in. But at the end of the day, pretty much all financial institutions have some kind of financial risk related to climate change. So starting off with asset managers, so superannuation funds, they obviously own assets. So those assets could lose value, and that has obvious implications. Banks make loans, and they may face higher probability of default or less ability to recover the value of the loan should a default occur. I was just going to I'll go back to banks in a second, but I thought it was really worth talking about insurers. So they're a really interesting case because they're actually one of the financial instruments that individuals and banks actually use to manage the risks of things like climate change. And they're quite interesting because insurers can update the premiums they charge each year. So as the nature of the risks evolves and they learn more about them, they can change the premiums that they charge. So they can adapt relatively quickly. The other thing that insurers are quite good at doing is understanding the nature of the risks and understanding what could be done to mitigate the risks and setting up incentives to get that to happen. So an example here is that apparently a huge amount of the damage from cyclones comes from roofs being ripped off and causing damage to the house itself and to other property. So if you just put in place some building codes around the length of nails, you actually mitigate the risk of a roof being ripped off and therefore reduce the costs involved. And so insurers have responded to that kind of information, said, well, actually, we'll charge you less of a premium if you put in place some of these mitigating investments. So that's kind of an interesting adaptation that's occurring. But even then, there are already some examples where properties have become uninsurable because the costs, because of the increase in the frequency and severity of climate risks means it's just not worth insuring. So just take it going from the example of the insurer to a bank. The problem for a bank is actually quite a bit more complicated. So one of the issues is that they have to think about much longer time horizons. So, if you think about the length of a loan, it's usually a lot longer than a year. And another problem is that they can't adapt to the pricing very quickly necessarily. And one of the things we do know about climate change is that history is not always a great, it doesn't give us a particularly good idea of what's going to happen in the future necessarily. So as I discussed above, scenario analysis is really helpful when you're in one of these situations where there's just a lot of uncertainty, either because of the length of time we're dealing with or the nature of the risks is really hard to pin down in a concrete way. So to give you another example, I'm going to use another bulletin article that's actually in the same edition of the bulletin as the previous one. And it uses scenario analysis to basically look at the risks to banks from climate change. It has a very sort of top-down perspective on this question, and it uses NGFS scenarios to have a look at what would happen in a world where temperatures get to more than 4 degrees. So that's a scenario that's quite similar to the current policy scenario in the previous graph. And what the article does, it uses that sort of top-down perspective to estimate the changes in the incidence of risks like riverine flooding, coastal inundation, and ground subsidence from drought, and tries to translate that into an expected decline in residential property prices at the individual property level using a whole range of data that's in the article. And that interestingly shows that a lot of residential property isn't really expected to have much of an effect from physical risk as a result of climate change. But for the properties that are affected, the price changes can be really quite large, and they're quite geographically concentrated. So on the next slide, I have a graph. So basically on the left-hand side, what I've got is just for the capital cities, colouring in, and it shows you which properties are going to be most affected by these risks. And you can see that for capital cities, which is where most of the residential property is, the risks are highest in suburbs that are along the coast, which is telling you that inundation is a particular issue, and Brisbane is going to be particularly affected relative to the other capitals shown there. The other interesting thing that the paper looks at is transition risk, and how it tries to look at that is it says, well, let's look at the emissions of different industries and work out which industries have the most intensive or most energy intensive, and therefore are at most risk of experiencing the effects of structural change. So you can see from the right-hand graph there that electricity generation and agriculture are very intensive when it comes to greenhouse gas emissions. That's probably not a great surprise. But this is using national accounts data, so it's nice to see that the data we use accords with how we feel like things should be working. And it shows the estimates of 3 different levels, if you like, of emissions. So scope 1 is the direct emissions. Scope 2 is the emissions that come to an industry from the inputs that it uses. And scope 3 is capturing the emissions of industries that are downstream in the supply chain. I think it's fair to say that the confidence in the estimates probably diminishes as you go from scope 1 to scope 2 to scope 3. And so once you've got that information, you can look at the business loan book of banks to try and get a bit of an idea of how exposed banks are to these loans. You can look at the length of the duration of the loans. As I mentioned before, the longer the commitment, the more risk that you have. And that analysis actually shows that banks' exposures to carbon intensive industries or to climate change through this transition channel at least is relatively well contained. But there's nothing, this is a top-down approach, and there's nothing quite like looking at things from the bottom up as well. And so what we have is APRA, so the Prudential Regulator, is conducting what we call the Climate Vulnerability Assessment, or CVA for short, with the 5 largest banks. And what that is doing is looking at physical risk and transition risk associated with 2 of the NGFS scenarios, again, current policies, and one called disorderly transition, and basically does that exercise of translating that high-level narrative to the Australian case, because banks, to be able to look at the effect of all this on their balance sheets, need quite granular data on geography, industry structure, and the like. So quite a bit of work has been put into understanding the implications for the structure of the Australian economy of these different scenarios. And I think the other thing that's really important here is to make sure that we also have a macroeconomic overlay that is consistent with those scenarios. So I think what I'm getting at here is, if you think about a company, you can look at the company can look at its own activities and go, oh, well, this is the effect of climate change on me. But they also need to take into account what's going on in the whole economy. And it's very difficult to do that if you're an individual business. And so in this exercise, because the 5 largest banks obviously have exposures across the whole economy, where we've got that macro overview getting added in. So that is ongoing. We're through the design phase. We're actually at the point where banks are looking at their balance sheets, and the results of all that should be available in 2022. So I just thought I'd take a little step back and quickly talk about what's the role of financial regulators in all this. So that I've made the case that the Reserve Bank has a mandate for financial stability, and therefore, as climate change has financial stability consequences, we need to care about it. But there's a whole range of agencies in Australia that have that responsibility from different perspectives. So it's a cross-cutting issue, and we really coordinate the domestic work in this space through the Council of Financial Regulators. So that's the Reserve Bank, APRA, ASIC, and the Treasury. So we have a sub-working group. Guy DeBell, who I think spoke to you earlier, is the chair of that sub-working group. And basically, the starting point here is that climate risk creates financial risks for financial institutions and companies, and they should be managed the same way as any other financial risk is managed, so that it doesn't kind of create these financial stability issues. And then the next question is the public policy question, is what can financial CFR agencies actually do to facilitate this process of managing risk effectively? So what can we do to make sure that markets and investors price risks and opportunities as effectively as possible? So there's a list of 4 things there. I have to admit, I don't have a clock in front of me, so I don't know if I'm going horribly over time. So I'll go through this relatively quickly. So APRA and ASIC have provided quite a bit of regulatory guidance about what they think appropriate standards for risk management look like. The second point there is the CVA exercise itself has been a big pillar of what we've been up to, and that sort of serves the purpose of thinking through what good scenario analysis looks like, so that there's a bit of a benchmark for anybody wanting to do a scenario analysis in the Australian context. There's a lot of learning by doing in this space. So I've already mentioned that we do a lot of engagement with international peers on these topics. But even domestically, you'll be comforted to know that the domestic banks have already been thinking about these issues and were closely involved in the design phase of the CVA. So, there's a lot of learning by doing and making sure that we don't let perfection get in the way of progress. The third point I have there is disclosures. So a lot of the information investors and markets have available actually come from what firms tell them about their climate risks. So it is important to have good standards that people know what they mean. And there's been quite a lot of activity in this space recently. And if you were getting down in the weeds of COP26, you would have seen that there's a new standards board being set up to set up accounting standards for climate risk. Taxonomy is a very arcane space, but basically it's a fancy word for definition. So it's just really helpful if everybody has the same understanding of what green means. So, you've bought a green bond. What does that mean? Well, if everyone's got a standard set of definitions, that's pretty helpful. And I guess here there's a tension between the benefits of having really standard standards and then having standards that are well suited to a particular economy, because every economy's got its own specific features. So, what's the happy medium between those two pieces? So just very quickly, I see Jackie's turned herself on, so I must be running out of time. So what is the bank doing in this space? The answer to that is a whole lot of things. We do quite a bit of analysis, some of which you have already seen, to understand how climate change flows through to the macroeconomy, may affect monetary policy, how it might play through to financial stability risks. We're pretty actively involved with a lot of the CFR work. So I sit on the steering committee of the Climate Vulnerability Assessment, for example, because there's that macro dimension, and of the agencies, the RBA has more macro expertise than APRA, for example. We've been involved in a lot of international discussion, and when I say a lot of international discussion, there is a lot going on. And just finally, I haven't talked about this at all, but it's all very well for us to say, well, you should all be paying attention to the climate risks that you have. But we are also in the background looking at our own carbon footprint and looking at our own activities. So obviously, as a business, we use electricity. That's one obvious one. One that's perhaps a little bit more specific to central banking is, our note printing operations are obviously a manufacturing business. So, the question is, are there ways for us to minimise the carbon footprint of those activities?